Hello and welcome to the Business Standard Banking Show. The Reserve Bank of India decided to keep the policy repo rate unchanged for the second consecutive policy review and lowered the inflation forecast for FY24. What does it mean for the banking sector? To understand its implication, we today have Sanjiv Chadha, MD and CEO of Bank of Baroda, to discuss some of the policy implications of the RBI action and the bank's initiatives. Mr. Chadha, welcome to the show.
Thank you, Monojit.
With RBI keeping rates on hold for the second time, do you think lending and deposit rates have peaked?
So I would believe, yes, I think this is what the anticipation was even over the last few months. If you would have noticed, the trend of banks increasing deposit rates now seems to have leveled out. And therefore, we probably are near peak rates as we speak now. Of course, I think the RBI has kept its stance in such a manner where its options are open. But I think from my perspective, I think rates are pretty much near peak. Of course, the inflation trajectory would need careful watching, which is what the RBI is doing. But I don't believe that we should be seeing any significant spikes from here on.
There is another development which has happened in the last few days, which is the 2000 rupees note withdrawal, and banks are getting 2000 rupees notes back. Do you think the withdrawal of 2000 rupees note put a downward pressure on deposit rates? That bank could revise the deposit rates downward because of this inflow of 2000 rupees note.
So I think if we were to assess the relative importance of things, I think in terms of relative importance, it's much more important that inflation seems to have peaked and now is on a downward trajectory. Also, that the Reserve Bank of India has at least been temporarily on hold for the last two policies. And also in terms of the deposit rates increasing, they also seem to be in a stable environment. In this context, the 2000 rupee note inflow, which is coming, I think it is possibly marginal, something which will have some one-off effects as we speak, but not something which is going to be of enduring importance as we move ahead. I think what is much more important is the inflation trajectory, which now seems to be at least stabilized.
Now, coming to growth on the loan side, now last year we have seen the banking sector is growing at a healthy pace of 15%. Do you think such kind of growth be sustainable in the current financial year also?
So I think if you were to examine the last few quarters, you would find that probably in the last quarter, the growth rate had started tapering downwards. Because while there is a broad-based recovery which is underway, but nevertheless, last year there was some impact of the post-COVID bounce which was there. Now that is no longer going to be the case. So our own sense is that we should see probably on an average a growth in maybe about early teens, 13-14%. I think that's what we are penciling in from our perspective.
The other challenge was for the banks was the deposit growth, which was lagging the credit growth. Do you think deposit growth should pick up this year? And is it a
So I think
concern that deposit growths are lagging the credit growth?
so. I think I can only speak from our perspective, Bank of Baroda. So for us, deposit growth was reasonably healthy. In fact, the differential between deposit growth and advances growth was just about 2-3%, and we are still again on a domestic CD ratio of 75%. So I think from our perspective, deposit growth is not constraining advances growth in the least. There are always cycles which are there. Over the last 3 years, maybe 2 years back, there was a time when deposit growth was significantly ahead of advances growth. The opposite was true last year. I believe that this year, both should move largely in tandem.
From Bank of Baroda's perspective, how do you think your net interest margin to pan out in the current financial year, given that interest rates have peaked?
So we have guided that the last year net interest margins were about 3.3% for us overall, and we exited the year at about 3.5%. So our guidance is that we would probably have a similar net interest margin this year also, which means we should be able to absorb the impact of the elevated deposit rates, which will be there for the full year, because there are some idiosyncratic factors which operate and also some general factors. The general factor is that the MCLR keeps on getting repriced for next 12 months, which will to some extent have a countervailing impact. And what is idiosyncratic for us is that there's a composition change which is happening in our balance sheet. This proportion of retail is going up. Last year, our retail loans grew by 28%, where the spreads for us are better. Also, in terms of corporate loans, I think the tightening of the liquidity has meant that some pricing power has returned. Also, this year we expect that the proportion of international in our book should be a little lower as compared to last year. Last year, overall growth was 18% in loans and international grew by 30%. We believe that international will grow on in line with overall growth. And since NIMs in international are lower, therefore, again, a proportionate increase would mean that that supports margins to some degree. So our overall assessment is we should be able to protect our margins despite the fact that there will be some dampening impact of the increase in deposit rates.
Right. You talked about the MCLR revision, which could be one element to protect your margins. What are the portion of loans which are linked to MCLR for Bank of Baroda?
So for us, that's relatively high. It's probably about 60%, which is why that gives us a bit of protection there.
60% loans are linked to MCLR. The other issue which is dominating the banking sector these days is the expected credit loss framework. Now, RBI has issued a discussion paper. They have also asked feedback from the banks. What is your overall sense of the impact of this ECL model on Bank of Baroda?
So I think we have to look at this in two contexts. One is, of course, where credit costs are, sans the ECL model. So last year, our credit cost was at about 0.5%. And the benign environment, both on our corporate book and our international book, continues. So it is quite possible that that credit cost could actually go even lower than that this year. And also to the extent that we can foresee in the future, I think next 2-3 years should be fairly good, which means that there's enough room which is there to absorb any ECL amortization which might be there. Of course, the exact figures we'd get to know once the RBI comes up with the precise definitive guidelines.
With your net NPA ratio less than 1%, do you think that gives Bank of Baroda an advantage in a beneficial advantageous position to adopt the ECL norms?
So I think both things work. One is your stock, right, which is your current book, where, as you said, the net NPAs are about 0.89%. Gross NPAs have been coming down, and gross NPAs are plus written off assets are provided to the extent of 92%, which means that the scope for additional provisioning is very, very limited as we go forward. Along with that is your current book. Now, as I mentioned to you, in the current book, the credit cost is coming out at very, very low levels. So both these two things in tandem, the well-provided existing book and the low credit costs that are there now and which we foresee to continue, they are likely to again help us absorb any ECL impact that might be there in the future.
What could be the impact on Bank of Baroda in the first year when the ECL is impacted? Because you can amortize those over 5 years. So, what is the impact on first year on capital?
So I think our guidance is that we believe that on a stable basis, credit costs, which of course are very low at 0.5%, should be within 1% for the bank, which means through the cycles. And our assessment is that if we were to add the ECL amortization and the credit costs that we see now, we will be within this standardized figure, which means that the profit trajectory that we see, that should continue unimpaired despite any ECL impact that might be there.
And finally, sir, the Bank of Baroda has recently initiated the Raster Salman Awards. What was the motivation for this initiative?
So I think, first of all, I think the bank has been associated with literature and the arts. We have been sponsors of the Jaipur Literary Festival for very many years now. But it really grew from the realization that if you or I have to read again a novel which has been published in any Indian language, whether it's Bangla or Tamil, you perforce have to depend upon an English translation, which to my mind is very, very unfortunate. And therefore, again, we thought that if our Rashtra Bhashas, so we have got 22 languages in the 8th schedule, which are all our national languages. If literature, which is so rich, which is published in these languages, if this could be made available in Hindi, it would have two big benefits. One, of course, is that these languages, which are so rich, they will again get audience which is much wider, a national audience which would be there. And also the readers in Hindi, they would benefit from again gaining from the literature in a context and a language which is much closer to us as compared to English. If I read a Bangla novel, I've read Rabindranath's translation in Hindi, that sounds so much more authentic as compared to if I would read it in English, right? Because there's a shared vocabulary, there's a shared context which is there. So I think this award encourages translation. It means that again, there are novels, literature which is published in all Indian languages. That will get a big boost as we move forward.
Right. And finally, you will be completing the 3-year tenure in Bank of Baroda, 3.5-year tenure in Bank of Baroda. What are your unfinished work that you would have liked to finish but you could not?
So I think it has been a very satisfying period. First of all, let me just amplify the point that we were discussing about the Rashtra Samman. So the process that we have adopted is that we have had a long list which is there of 12 books, and which is now a short list of 6 books, and then one book gets the award finally. This is also possibly the richest literary prize in India. So it's something that we are very proud of, and I hope we can continue that. But I think in terms of the unfinished agenda, banking is so dynamic that there will always be something that you need to do, not next year, but tomorrow. But I believe that today, as we speak, the bank is in a very, very sound competitive position because of the investments that we have made in technology, how we have actually translated those investments to customer experience through Bob World, what we have been able to do through business correspondents. We have 50,000 of them, which means that we have been able to bridge the digital divide. And also we have been able to translate these advancements into, again, business. So we, as I mentioned to you, our loans again grew at about 18.5% last year, significantly above the market. Our deposits grew maybe another 3-4 percentage points higher than the market. We have built new businesses like the wealth management business over these years. So I think the bank is very well positioned as we go forward. And most of all, we are so fortunate that one of our executive directors is taking over from me as the MD of the bank. So the element of continuity, I think, is of paramount importance if you want to build upon the success that the bank has enjoyed.
So continuity is a very positive aspect for the bank, as you have rightly pointed out. So on that note, Mr. Chadha, thank you so much for speaking to Business Standard. It was always a pleasure talking to you.
Thank you, Monojit.